and we are a nonprofit credit counseling service that's grant funded, so we don't charge for the majority of our services. We are we're not financial advisors, financial planners, so we're not the people you call to ask who you should invest your money in. But we do more basic rudimentary counseling for people regarding any personal household finance situations, such as considering bankruptcy, or how much home can I afford, or how do I pay off my student loans, or I have some debt issues, I'm trying to figure out how to consolidate debt. So those are the questions that we help people with. And again, we typically don't give advice, but what we do is we educate. So for example, if someone calls us and says, I have some debt trouble and I'm considering bankruptcy. We're not going to tell them what to do, but we will ask to see their situation. We'll look at their financial condition. We'll look at their income, their expenses, and their debts. And we will say, okay, this is the type of bankruptcy, because there's different chapters, 7, 11, 13. We will say, this is the bankruptcy category that fits your situation. If you pursue this, this will be the benefit for you in terms of, your debt reduction and things like that. And then we'll say, and this is the downside for you. And to help us, or to help consumers and households have at least a solid knowledge when they're making those decisions, the personal household financial disinformation or knowledge that we all in theory should have learned from school and from our parents growing up, and in reality many of us, including myself, didn't. I learned the things that I'm teaching today the hard way. I started my life with a bachelor's degree in psychology from Eastern Illinois University way back in the last century. And it wasn't until much later in life when I went back and got a master's in business administration from Robert Morris University, which is now uh, cons they conjoined with am I thinking Roosevelt University, but it wasn't until I got my master's degree that I understood a lot of things that I should have known when I was younger. So let's put it that way. And so one of the reasons I work with consumer credit counseling services, because I love what they do. They do, as Bob kind of touched on, they do a great job of helping people and households have a better understanding of their finances, and making decisions that have knowledge. So today we're going to talk about reverse mortgages, and whether it's the right situation for you is really a personal situation. But again, we're going to try to help you get some education so that if you pursue this path, that it's right for you. So we'll get into it here. What exactly is a reverse mortgage? As Bob said, it's a home equity conversion mortgage. A reverse mortgage is a loan against equity. It's basically a home equity loan that isn't paid off in monthly installments. It's paid off in a lump sum at a certain point in time down the end of the roads, typically when the house is sold. Because when you're taking the equity out of a home, and turning it into cash to use for things, when typically with a home equity loan, you pay that off on a monthly basis over a 10-year period, a 15-year period, whatever it would be, just like any other loan. This is the same thing, except all that money that should be paid isn't owed until the house is sold. So that's really the unique aspect of this reverse mortgage. And it's right for certain people in certain situations, specifically um, people who are, senior citizens who have a significant amount of equity in their home, but they don't necessarily have a bunch of cash on hand, and they would like to stay in their home. That's really what this was designed for, and that's really what it's best used for, or intended to be used for, I should say. So some important facts, then we'll kind of start digging into the weeds a little bit here. You don't need an income to qualify for a home equity loan. However, there is a financial assessment to determine your ability to pay the loan. You don't have monthly payments. You keep the title to the house. The disbursement limits or the disbursement is limited to closing in the first 12 months, and I'll get into that a little bit down the road. But typically, when when people take out an home equity loan, I'm sorry, when they take out a reverse mortgage or an HECM, they become eligible for the disbursement of funds either as a line of credit, monthly installments, or a lump sum. The initial disbursement is the first of the funds that come out, and there are some limits up front that we'll talk about a little bit. There is just some facts off the shelf here. There is a 3-day period where you may cancel the loan if we desire. Funds may be dispersed, and I kind of talked about this as a lump sum. It can be dispersed as monthly payments or a line of credit, depending on the loan. So again, it's a simple concept, but it has a lot of options to it in terms of the payment coming to the borrower, as well as the end of the day, how the qualifications are managed compared to traditional loans, because of the fact that it's not paid off until the house is sold. That adds a little bit of a caveat to the actuarial numbers. So funds may be dispersed either as a lump sum, monthly payments, or a line of credit. If the borrower opts for a lump sum, there is a limit in the initial disbursement, and that's what that's talking about down at the bottom, which is 60%. And what that means is if you have $100,000 available equity and that's approved for this loan, so you have basically $100,000 loan against your house. If you take it as a lump sum, the maximum disbursement you're going to get is 60% off the bat, which is $60,000. And that's for that first 12-month period. And again, it's just a condition required by the lenders and FHA, which governs most of these loans. Although just like other loans, there's conventional / private loans, or the federal insured loans, which are FHA and backed by HUD and FHA. So, and again, the basically follow current interest rates. The qualifications are, or what affects the disbursement amount you can have is the age of the borrower, the current interest rates, the home's appraised value, and then FHA has a loan limit. So how much you can take out of your house depends on those factors. And again, we're going to dig into that a little deeper here in just a little bit. So some more facts. These loans are significant. They can be financed, or I'm sorry, loan fees are significant. So the closing costs, appraisal fees, home inspection, all those things that have to happen are significant, just like a typical mortgage. They can be financed at closing, so that can be rolled over into the loan. There's points, closing points. There's costs just like any other loan. However, those can all be rolled into the loan, which again then basically just takes away the amount of cash that you will have from that loan to use as you desire, or as the lender desire. I'm sorry, the borrower desires. The loan balance does increase over time, again, because it's a loan. So if we take out a $100,000 loan and we are, and we have that $100,000 and we use it to live or for whatever we need it for, that $100,000 is going to accrue interest just like any other loan every month. There's going to be an increase, and so the balance is going to increase. And because the payoff date of these loans are in a sense uncertain, because they're not due until the home is sold, or the surviving, or the last surviving borrower passes away. Because that payoff date isn't known, there are some hedges that the lenders take to how much they will allow us to take out of our house. So a typical home equity loan that has, a specific term, 10-year, 15, 30-year term, the algorithms for that lending process is different than the reverse mortgage, because there's that questionable payoff time, and that just changes some of the numbers and complicates the numbers a little bit. But we can kind of get an idea of what those numbers are, and we can at least understand after today, hopefully, whether this is appropriate for you or someone or not, because it's appropriate for some people and for others it's not. So some other important facts: the borrower must keep the home maintained and pay property taxes and insurance, as well as homeowners assessment fees if there are any. And so as long as those conditions are met and the home is the principal residence of the borrower, then the loan is not paid or it does not have to be repaid. But if those conditions aren't met, just like any other mortgage, foreclosure can occur. So those things to keep in mind as we go through this. And of course, at CCCS, at our organization, Consumer Credit Counseling Service of Northern Illinois, we have certified credit counselors that can help you or anyone make this choice. And I'm going to touch on that a little bit more as we get to the end here. So, non-recourse limit means what is the total amount owed? And so this term is important because the borrower isn't going to be allowed to get an amount of money out of this loan that goes above that non-recourse limit, which is what is the value of the home at the time the loan becomes due and payable, and then what is going to be owed at that time, which includes the money borrowed plus any points, fees, interest rates due, or interest funds that are due, etc. And so it's a little bit more challenging to find those numbers compared to a classic home equity loan, but it can be done and it is done. And we're going to get into that a little bit. So who's qualified? To qualify for a reverse mortgage, we need to be 62 years old. It needs to be our principal residence, and at least one of the homeowners must live in the house at the time of closing, and we must commit to continue to living there. And again, we'll get into the weeds on that a little bit down the road here too. If all those answers are yes, then qualify to apply for the loan. There are some other conditions. It's possible, and this happened to my father actually about 15 years ago before he passed away. He wanted to get a home equity loan, but the equity in the house didn't cover the repairs that were needed on the house and didn't match up to certain standards from HUD regarding the overall market of the neighborhood. So the value of the home itself, the repairs, if any, that are required, and the value of the neighborhood comes into that equation also, and we're going to touch on that as well. So if we're talking about non-borrowing spouses, if both spouses are listed as joint borrowers on a house that they own, then this doesn't apply to them. But if a single spouse takes out a loan, the non-borrowing spouse may have to pay that loan off upon the death of the borrowing spouse. So in other words, if you have a husband and wife and the husband takes out the loan and the wife is not named on the loan and the husband passes away, the non-borrowing spouse may be required to pay off that loan. Now, FHA has put in some policies where they have the potential to stay in the home following the death of the last surviving borrower. However, just like other mortgages, there's FHA/HUD secured or insured, I should say, loans in the home equity, in the reverse mortgage, the conversion mortgage, as well as there's conventional or private borrowers. And so the private borrowers may require that the non-borrowing spouse pay their house at the time that the borrowing spouse passes away. FHA typically allows them to stay. Some other facts: the loan will be the age of the youngest person, borrower or the spouse, again, because there's actuarial, formulas put into play in terms of loan you'll be allowed to, or how much equity you'll be allowed to take out of your house for this loan, again, based on actuarial figures and our age, the age of the borrower. Non-borrowing spouse is not allowed to access funds through the reverse mortgage, so that's another thing to consider if the borrowing spouse passes away. Eligible properties are typically single-family homes, so a house, a townhouse, some condos, not all condos may be eligible. Manufactured homes must meet FHA standards, and planned unit developments may or may not be eligible. So if you're in a mobile home facility or manufactured home area, may or may not be eligible. It's kind of an individual basis. Some more facts about eligibility: the loan may not be approved if the property doesn't pass inspection or the home value is deemed too risky by the lender. And again, that's what happened to my father. So this HECM loan may not be approved, even though we may have equity in our house and say, well, I have this equity, I want to be able to use it. If the lender feels that the repairs needed on the house aren't are more than the loan itself can handle, or even if it is able to be handled, they just might not want to take a gamble on that, as well as the neighborhood, whether the home value in terms of the property value based in the neighborhood may uh, may prevent us from getting a home equity loan, even though we have equity in the loan. So again, something to keep in mind. And we're going to dig into some of that a little bit deeper also. So just in terms of the types of uh, of home equity conversion mortgages or home equity loans, reverse mortgages, the classic one is the original single disbursement lump sum payment FHA insured loan. So this is the classic reverse mortgage here. This first type, we're going to talk about a couple other types. This first type being the home equity conversion mortgage, a traditional one, and the payment terms. And this is where the borrower takes out an amount of equity in their house, and then they are paid either a lump sum, or they can also be paid through a term, a tenure, or a line of credit, or some modifications in those. And so a term payment option is basically equal payments of a loan over the time of the loan on an agreed upon time frame. So in other words, you can take out a home equity line conversion, and if it's $100,000, you can have that divided up by 20 years and then be paid out monthly over 20 years. Once that term is up, then the loan isn't due because you still get to stay in the house. You don't have to pay it until the loan is closed. But if you take a term like that, a 10-year, 20-year term, you'll get those monthly or bi-monthly or annual payments. But at the end of the term, then those funds are going to stop coming in. Tenure is where you obtain monthly payments until you reach 100 years old or pass away. So the actuarial figures, they consider that the youngest spouse will live to be 100 years old, and so they'll put out a monthly payment or an annual payment based on that calculation. And then if we turn 100 years old, again, we still get to stay in the house. We don't have to pay it back until the house is sold, but that money stops coming in. And if we pass away before we turn 100, then the money is due as with the traditional reverse mortgage. It's due when the house is sold or the borrower passes away. Okay, and then there's different modifications for those also. You can have a modified term or modified tenure is just the 10 term or the 10-year um, the formulas with a thrown in, lump sum. So you might be able to take, a 20,000 lump sum payment and then have the rest of the loan turned into a term or a 10-year payment schedule. And of course, a line of credit is also another option where that money is just available should we need it. So, and again, what's right for us is an individual decision. Some other types of reverse mortgages. Now, the one I just talked about back here, this is the classic reverse mortgage, FHA, home equity conversion mortgage. That was the original reverse mortgage, home equity conversion mortgage. There are some other nuances that have been added to the plate over the years also. So there's a single purpose reverse mortgage. It isn't available to everyone. It may be only used for one purpose. Most homeowners, or it's more homeowners, I wouldn't say most, I would say more homeowners qualify for this than for other mortgages. And it's because it's the money is understood by the borrower. I'm sorry, by the lender. The money's understood by the lender to know what it's going for. So when we take out a loan like this for a single purpose, the lender is more comfortable giving us money because they know what it's going for. And typically this would be for someone who has a tax problem. If someone's gotten behind on their real estate taxes and they may lose their home, this would be a good purpose, and this is a common purpose for this type of a home equity reverse mortgage. Or as well as maintenance. If the house needs a specific amount of maintenance with a specific dollar amount, again, and the lender can see that, and the lender knows where that money's going. Again, most homeowners will qualify for this compared to the other types. Another type is a proprietary reverse mortgage. It's a loan that allows seniors to access the equity in their loan from a private lender. These are not as tightly regulated as the HECMs, the home equity conversion mortgages that we talked about. They're not federally insured by FHA or through HUD. And so these are basically all up to the lender of whether or not they want to do this loan. And so what this loan works best for is people who typically have an expensive house. They have a lot of equity. They have a valuable house with a lot of equity, and they may qualify for more funds than with an FHA. So if you're someone who has an expensive or a valuable home and a high equity built into it, the private lenders will be more willing to work with you than some of the ones with more of a narrow margin where FHA is appropriate. And these terms may be better for those people because it's not federally insured. The banks are comfortable with the equity in the house that they're not going to lose money. So the federal insurance isn't required, and therefore some of the fees can be a little lower. All right. So some interest rates, because just like any other loan, you take out the principal, and then interest is charged on that principal consistently until the loan is paid back. So again, that's something to keep in mind. And so the interest rate calculations are they used to be based off of LIBOR, which is the London Interbank Offered Rate, but since like 1923, LIBOR's been phased out, and so the U.S. Treasury Department uses this secured overnight financing rate, which is it's a benchmark interest rate based on actual overnight transactions collateralized by U.S. Treasury securities. So, long story short, that's a more of a solid, consistent number to base the interest rates off of. There are some variable rate margins if you have a monthly adjustable mortgage, and they can differ slightly monthly to monthly. Again, depends, and that might affect if the money's available. So, and there can be a 10-point cap on the monthly adjustable rate. So because this SOFR index varies, the interest rate on the mortgage may vary. Again, and that depends on the lender. Most of the FHA HUD loans that we talked about are fixed rate, but lenders may have variable rates based on this SOFR index, this again, secured overnight financing rate by the U.S. Treasury, this index. And so it may vary over the course of the loan, and there can be a cap on the monthly adjustable rate, which kind of makes sense. Annual adjustable mortgages do have a margin added to the index. There's a 5-point cap on the annual adjusted rate. And again, a fixed rate is just that, it's fixed. The adjustable rate mortgage has a margin added to that cost, which is again a small amount. The HECM loans that are FHA secured or insured, I should say, are limited by HUD home value limits. So HUD decides this value cap for the house, and they've been doing this for a long time. That's really what their expertise is. And so they will basically put a limit on the value of the house, which then puts a limit on the value of the reverse mortgage. And again, going back to what I said earlier, if you have a high value house and with a lot of equity, a private reverse mortgage might be better suitable than one that's government insured by FHA and HUD. Something to keep in mind. Okay. Mortgage insurance premiums are required. They are typically an upfront cost. And of course, all of this can be rolled into the financing, but it's equal to 2% of the max claim amount for mortgage insurance in the area. And again, that's a formula utilized by HUD. And so HUD sets those numbers, and the insurance premium is based off of those numbers. It can be paid or financed at closing. And then there's an annual premium of 0.5% is charged on the rising loan balance, because again, when you take out this loan, it's going to continue to grow even if you take a lump sum and then don't do anything for 20 years. That loan is going to continue to grow. That dollar amount owed is going to continue to grow because interest continues. Just because we're not paying it until we sell the house doesn't mean that that interest doesn't continue. So something to keep in mind. Origination fee. Lenders may charge an origination fee. It's typically capped. Again, if it's an FHA loan, it's going to be capped, as it says right here on the slide, 2% of the value of the property up to $200,000, and then 1% above that, with an overall cap of $6,000. But we may be looking at origination fees in the thousands of dollars. Again, and this can be paid for or financed at closing. Other costs, the typical closing costs, an appraisal is going to be required. It's usually an advance payment that may, again, be refunded and added to the loan balance at closing. Same thing with the credit report. It's typically required that the borrower have a credit report run, and again, may be refunded to the borrower and finance once the loan is approved. Hazard flood insurance may be required. Replacement value coverage is typically required. Other costs may be listed right here: title search, survey fees, required inspections, recording fees, et cetera, taxes. So this isn't different from an ordinary loan in the sense that all of these costs are going to be included. It's just they're rolled into the loan and then they're paid off when the loan is paid off, when the house is sold. But they don't go away, and interest continues to grow on the outstanding balance over the course of time that loan is in the hands of the borrower. So existing mortgages and liens typically must be paid off. So again, if we have a house that's worth $300,000 and we still owe $100,000 on the property or on the original mortgage, typically the home equity loan then will be more than $100,000, and the first $100,000 of the home equity loan will be used to pay off the original mortgage, typically, or it must be subordinated to the home equity loan, but typically the mortgage is going to be required to be paid off and the original mortgage by the home equity loan. Repair set-asides is another thing that may be considered. So if you have a house that has equity available in it, however, maybe it might need some repairs that are, discovered during the home inspection or during the appraisal, the lender may require that those repairs be made as a condition of the loan. And so they will then set aside money from the loan to pay those repairs, and then it'll be released once those once those repairs are made. Something to keep in mind. In terms of payment options, we kind of talked about this again. The borrower is going to get payments from the lender. Could be the 10-year concept I talked about, monthly payments as long as we're in the house. Could be a lump sum at closing with those disbursement limits that I talked about, that's 60% in the first 12 months and then the rest afterwards. It could be a line of credit. And of course, it could be a term loan where money is given monthly to the borrower for a period of time that is selected. It could be 10 years, 20 years, 30 years, whatever is agreed upon between the lender and the borrower. All right, so those are typically the payment options. There are some modifications, and I touched on this a little earlier already too. The borrower may combine a line of credit with a monthly payment for a fixed number of months. That's the modified term, or the same thing where the line of credit is added along with monthly payments for as long as the borrower remains in the home and until the home is sold. Okay, there is some flexibility. We may change options if our situation changes or the borrowers request a different arrangement. That is a possibility. It is an option usually. And now talking about repayment, typically when we start talking about repayment, We're talking about paying at the time that the last surviving borrower dies, sells the home, or permanently moves from the home. Now, if we win the lottery, we can pay it off. So borrowers may partially or fully repay the loan at any time without penalty. And again, this might not be a bad idea if you consider that as long as that principal is outstanding, there is interest growing. So if we've taken out a home equity loan and 10 years down the road, our aunt dies or we get an inheritance or we win the lottery or something happens, we may want to pay that loan off or at least pay part of it off to reduce the amount of interest that's going to be charged at the end of the loan and 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 when the house is sold. So the lender may foreclose for certain situations, specific situations. So if we don't pay our property taxes, the lender may foreclose. If we don't pay our property insurance, our homeowners association dues, the lender may have the option to foreclose. If the property goes into disrepair, the lender may also foreclose, or if it's an FHA, a HUD loan, the property has to be maintained to those standards. And typically with the private loans too, there'll be some standards that the house has to be maintained within in order for that loan to be approved and to be agreed upon. So, okay, other factors here, some borrowers' obligations. The borrower is obligated to maintain insurance, pay taxes. We touched on that. We have to live in the house. And so the definition of living in the house means it has to be our primary residence for 6 months out of the year. We may live elsewhere for 12 consecutive months if we have, a physical setback or an illness. Money from the reverse mortgage is not income, so it's not taxable, does not affect Social Security or Medicare. Reverse mortgage may affect Medicaid or Social Security income statements. So if people are on Social Security income or are receiving Medicaid, the reverse mortgage may affect their status with that or their allotments. But it's not income in terms of our taxes. We won't have it used as taxed against us as we age. However, it will be taxed upon the sale of the house. The tax will be, considered the same as any other sale, and of course the interest will be paid then too. Some other facts to think about: if we're in a senior property tax assistance program, or if we're in the properties in trust. If the property's in trust, that's a whole nother ball game. That's a whole nother educational session, if you will. But there's going to be some complications if the property is in a trust, and so that's going to be an individual situation that is going to have to be looked at, and if that's the case. But if we're eligible for property tax assistance, the reverse mortgage may affect that. Again, something to keep in mind and to work through as we're doing this. Also, in people who obtain a reverse mortgage, they are required by HUD to receive counseling by a certified counseling who works with a HUD authorized agency. And again, otherwise they can't be approved for the loan, at least FHA loans. Private loans might be different, and we talked about that a little bit. And then typically that housing fee is $100 to $200, and again, may be lowered or waived by HUD or the agency doing that counseling, and or maybe rolled into the loan potentially too, or refunded, I should say, upon approval of the loan. So that's pretty much what I have. Again, we're Consumer Credit Counseling Service of Northern Illinois. We're funded. We're a nonprofit. We're funded through grants. Here's some of the organizations that have given us grants. We just try to recognize them and thank them for their service. This is who we are. I'll do a quick little just recap of us. We're a nonprofit out of Woodstock, Illinois. We have an office in Woodstock. We've been around since 1982. And we do outreach educational sessions such as this one. And then we also do individual one-on-one counseling regarding personal household finance questions. And because we're grant funded, we don't charge for the majority of our services. Here's our contact information. And I would suggest if this illinoiscccs.org, if you just want to jot that down or take a photo. The website basically talks about who we are. We also have a resource page that off connects to some good resources regarding mortgage calculations or any type of financial calculations and spreadsheets. And it's worth a cup of coffee on a Saturday morning to sit down and check out our website. So I always suggest that. And of course, we're available we don't have geographical boundaries in terms of the state of Illinois. So, you don't have to drive out to Woodstock if you want to seek our services. Everything can be done remotely through the phone and email. So we're there if people need assistance or questions. So lastly, and then I'll see if you have any questions. I'll do my best to see if I can answer them. Feedback is optional. If you want to take a look at this QR code, there's a quick survey just to help us make sure that we're giving presentations that are valuable and well received, as well as we report to our donors on the work that we do. Because as you know how nonprofits work, we work off of grants, and so we're always seeking grants. And when we receive grants, the grant writers like to have us provide them documentation or information that we're actually doing what we said we would be doing with that money. So that's it. And I'll open it up right now for questions. If anyone has anything to ask, I'll do my best to see if I can answer them.